Hi, ladies and gentlemen, and welcome to our webinar today. My name is Louisa Mazinta. I'm the Chief Growth Officer at Mesh Trade, and I'm absolutely delighted to be a moderator for today's discussion on a really fascinating topic, beyond the index, resilient portfolios in an uncertain world. We've got some wonderful speakers here today. We have Mohammed Nalla, who you would have all heard of before. He's a globally recognized macroeconomic strategist and co-founder of Macrotech Research. And Mo always comes to the party to help us unpack specific asset classes and investment strategies. We've also got Justine, who's the CEO of AnBro, who is a partner of ours and who has just issued the most amazing AMC on the Mesh Trade platform called Titans. And you'll see the link a little bit later. So before I ask Mo to start his presentation, I'd like to invite Connie Bloom, who's the co-founder and managing director of Mesh, to welcome all of you and to provide a little bit of context for the afternoon. Connie.
Good afternoon, everyone. It's great to have you around. And Louisa just mentioned that we'd be talking about the beyond the index, the resilient portfolio in an uncertain world. And I must thank you first to say thank you for being resilient as well. I know it's a Friday afternoon. I hear in South Africa it's quite cold and the schools just closed out. So you are really committed to learning about investments today and learning more from Mohammed and Justine. So at Mesh, when we look at these kind of assets and when we look at these kind of partnerships, we take into consideration a few things, because one of our ultimate missions is to ensure that we create a capital markets that's easy to access, simple to use, and transparent. And a big part of that is actually cutting through all this noise that you have around you and all this complexity to really help our investors to build a smarter, more resilient portfolio that actually works in the real world. And that's why I'm exceptionally excited about today's session. We're joined by two people that rethink the traditional portfolio models and really take a lot more entrepreneurial approach to the market, and something that is really sorely missing in today's industry. And speaking about Justine and AnBro, this is their fourth listing on Mesh. And honestly, it's just been such a great partnership. You'll hear from them around how they think about the fund space and how they definitely think about their investors and what is really happening in your portfolio. So this is where real innovation is happening, where sharp entrepreneurial thinking takes place to bring you a product that is not generally easily accessible in the rest of the market. It's generally very much in a closed market space, but now that it's listed on Mesh and available to you all, it serves the purpose of Mesh to open up the capital markets. So in this episode, we're going to look deeper. We're going to think deeper. You're going to hear some really interesting topics around how they've selected these companies to group together in these portfolios. How do we really think about actively managing funds? And obviously, Mo is going to come with a lot of interesting market insights as well. So we welcome you again today, and I'm going to give over to Mo and Justine to take it from here.
Thanks, Connie. Mo, over to you. I just want to ask everybody on the Zoom and in the room is, as you listen to today's session, I'm sure there will be a lot of questions that come up or thoughts that you want to share with the speakers. So please do enter your questions into the Q&A or the chat window as we go, and we'll make sure that we ask all of your questions. And we've got a couple of really esteemed guests here in the room. Thank you for joining us, who are also raring to ask questions. So without any further ado, please join me in welcoming Mohammed Nalla. And Mo, it's over to you.
Thank you, Louisa. Thank you, Connie. Really excited to be part of this event with Mesh, with AnBro as well. And I think you've set the bar on that intro so high, because now we just have to deliver some of those really interesting insights that I'm sure a lot of people, sometimes when you're thinking about your portfolio, it's not necessarily front of mind. So that's what we're going to try and do here. The title of the presentation is Beyond the Index, Resilient Portfolios in an Uncertain World. I'm going to share a bit of a slide deck with you And what I've done is I've tried to keep it fairly simple. But at the end of the day, a lot of the thinking that I'm going to try and share in these slides are insights that I've gleaned from working with the institutional market. It's insights from your big asset managers. It's insight from some of the world's largest pension funds. And we want to try and bring that to every single investor, make this kind of thinking accessible to everyone that's sitting in this presentation and beyond. So without further ado, let me just jump straight in. Just a little bit of background about myself. For those of you that are maybe not familiar with me, I've got over 18 going on 19 years worth of experience in financial markets. I head up macro tech research along with a partner of mine. And what we do in macro tech is we specialize in global macro, geopolitical, emerging market research, and investment strategy. Now, predominantly, a lot of our clients tend to be institutional asset managers, other brokers, platforms such as Mesh. And with that, what I'm looking at doing is really bringing, like I say, some of those insights from the institutional space and making those accessible to every single investor that is out there. I also currently sit as the co-chair or incoming co-chair of the Institutional Asset Management Committee for the CFA Society up here in Toronto. And why is that relevant? Why am I saying this? Why am I sharing it with you? Is that as a member of that committee, I get to interface with some of Canada's largest pension funds. For example, the CPP, that's effectively their government their government pension fund that currently manages over $450 billion worth of assets under management. We deal with people at Ontario Teachers Pension Plan. That's another $400 billion fund. And so what we do in that is we interface with them. We speak to a lot of experts across the world, and we see what are the institutional investors, the smart money, if you will, what are they doing in their portfolios? What can we learn from that? And what does that tell us about the overall markets and about the world? So that's just some background on myself, why I'm speaking to you here today. Let's get into what today's discussion is going to be about. And first and foremost, I've outlined just a high-level overview of what the presentation is. It's not very slide-heavy. I'm going to try and wrap this in around 20 to 25 minutes. I'll then bring in Justine. We'll have an interactive session, and then we can obviously open up for Q&A as well to hear what your pressing concerns and questions are. But in terms of the structure of the presentation, we'll start off with what is the problem with traditional portfolios? Then we'll move on from that into just diversification, why it works, why is it important? Then we'll outline some thinking around just a smarter portfolio framework. We'll also outline to you why not all indices are equal. A lot of people nowadays are quite taken with the concept of passive investment. You can just buy for example, an S&P tracker, and that gets you the top 500 companies in the US. But we'll unpack what are you actually buying when you're buying some of these headline indices, not to slam the S&P or the NASDAQ, just understanding what that is and what some of the pitfalls of that approach are. We'll then have a slide on just taking all of that discussion into practice, because having this discussion is pointless if we aren't able to draw a line towards actionable types of content. How can you actually execute this within your own portfolios, within your own world? And then we'll wrap that all up. Now, a big disclaimer up front, of course, is that this is for informational purposes. This is by no means financial advice. So obviously seek the advice of your personal financial advisors. Everyone's situations are unique. I've obviously got to put that out there. But let's jump straight in. And I thought this image is obviously a nice way to start with the problem with traditional portfolios, is because a lot of times people put all of their eggs in one basket. And what I mean when I say that, I call it concentration risks and faux diversification. And I'm going to unpack this for you because traditionally over time, investors tend to default to a specific asset class. And usually that asset class is equities. If you have a look at that, you can see how retail investors over time show that strong bias towards equities. I've seen people very close on retirement, and just because the equity markets have run so hard, where they have a very large position in, let's say, for example, a specific stock, say Apple. This is a real life example. I saw a person who's very close on retirement, and around 30% of their entire portfolio was in a single stock in Apple, just because Apple had done so well at that time. Now, the risks of this approach is that by leaving that, by not dynamically managing your exposures and your asset allocation, if you actually see a sharp correction in the market, and look, for the year to date, Apple's down 20%. So the discussion I had with this investor, it was during the course of the last year or so, was actually very valuable, because if they had left 30% of their portfolio in just that one stock, for the year to date, Apple has been very hard hit. It's down around 20%. And so on that basis, at this very critical time, very close to their retirement, they would either compromise their ability to retire, or if the portfolio is large enough, they would just compromise the quality of that retirement. And so this highlights some of the importance of just diversified asset allocation across your portfolio. Now, there's another dynamic here, and that is following corrections or drawdowns in the market. I mean, markets don't just go up in a straight line. When you see those events materialize, whether it's 2008 or that brief sell-off we saw during the pandemic, which then bounced very sharply, or the correction we had in April this year, following those kinds of markets events, investors tend to behave counter-cyclically. The fear kicks in because remember, investors are human. There's emotion, there's fear, there's greed. And in those instances, investors tend to actually behave counter-cyclically, which means that they remain overexposed to cash for extended periods of time, and they fail to deploy that capital efficiently. Now, that becomes a very big risk, and a way to mitigate against this risk, and we can unpack some of this in the Q&A, in the discussion with Justine, is that run cost averaging or investing consistently over a period of time across a variety of asset classes helps you mitigate against the risk of taking exposure to a single asset class at an inopportune time in its own respective cycle. So that's a very important part or very important concept to just resonate on a little bit when constructing your portfolio and when investing in your long-term portfolios over time. Now, there's another dynamic here. Many investors also remain overexposed to real estate. A lot of people don't consider this as part of their overall portfolio, but you might have unlisted properties. Some people are renting those out as Airbnbs, and that actually makes up a fairly large portion of your overall asset allocation. So I would traditionally say if investors are considering their overall asset allocation, always keep in mind that you do have this exposure to real estate and look at that within the construct of your overall asset allocation. Now, I'm going to pivot from that into a look at indices, into a look at equities. Because I started out by saying investors tend to be overly exposed to equities over the longer term. 60 to 70% of their asset allocation, traditionally, if you're looking at global investors, US investors, that's what made up by equities. And if we look at that, the market cap indices like the S&P 500, I mean, this is something you've seen in the media, but it's very nice to just break this down for you. If you look at the S&P 500, the top 10 stocks, just the 10 stocks out of 500 stocks, those make up over 35% of the index. Now, if you take those top 10 stocks, 8 of those are currently tech stocks. So when you're buying the S&P 500, what are you actually getting? And then if we broaden that lens a little bit, and we say, okay, right, let's look beyond the top 10. Let's look at the next 10. That next 10 only makes up around 10%. But again, if you then wrap that up and you say the top 20 stocks in the S&P 500, you're now sitting at almost half the index just being in 20 stocks. And that is why I say, even if you're buying the S&P 500, it's this faux diversification. And that is quite risky because if you look at the top left panel on this particular chart, that's just the year to date. So I just picked a random time frame. You can do this over any time frame you want. If you look at it on the year to date, look at how disparate that performance has actually been. Yes, you've got some of those top 10 stocks up very strongly on a year-to-date basis, but then you've got others down, like Apple, like Tesla, like Alphabet. Those are down in the solid double digits. So that's telling you that you're not necessarily getting a good, healthy mix of stocks if you're just taking a passive exposure to the S&P 500. Now, I looked at this another way, because this is now quite relevant to the discussion that we're going to be having with AnBro a little bit later on in this presentation. Unfortunately, if you look at the top performers within that S&P 500, again, over any time period, again, we've just done this on a year-to-date basis. And on this year-to-date basis, number one, that's Palantir Technologies. They're actually up over 88% at the time of me doing this report. But if you look at their weighting in the index, it's around 0.5%. So I've now done this across the top 10 performers in the S&P 500. And you can see that on a year-to-date basis, those only make up 2.5% of the index. So when you're investing in a market cap weighted index, you're just being driven by what the large caps are doing. You're potentially missing out on pretty decent returns that could come through in some of the other names in the index. And again, I could have done this and said, what are the worst performers? And yes, that does change the picture. But the point I'm trying to make here is that you're not getting the performance of 500 different stocks. You're really just getting the performance of the top decile of that index. And that is concerning given the current backdrop we have in the world. You've got geopolitical risk, You've got tariff tantrum risks in the US. This is not going to be a macro show. If you want to see what we've done on macro, I did a great webinar with Mesh a while ago. We discussed gold, and I'm anticipating we're going to do quite a few of these. But just given that global backdrop, given the changes and the shifts you're seeing in global policy, we really must take a smarter approach to how we manage portfolios over time, certainly as individual investors. Now, let's look at diversification, because again, this is a concept that I know a lot of institutional asset managers are quite familiar with. Some of you in the private client space may be familiar with this, but what does this look like in practice? And I'm going to start off on a basic level, just because I'm not sure what the level of understanding is within our audience today. I'm going to outline why diversification works, why spreading your eggs across multiple baskets actually makes sense from an overall risk-adjusted view of how you derive returns in your portfolio over time. We'll start off on a simplistic approach. So this is just for reference. What I'm doing here is you'll see in the upcoming slide, I've shown what a balanced portfolio looks like. But simplistically, what I've done is I've taken your traditional 60-40 split. So this is not being very smart. It's just saying 60% into equities, 40% into cash and fixed income type assets. You can see that on the top right insert. And then I've broken it down further, again, just for clarity. If you are a global investor, you have the ability to spread that into small cap equity, large cap, developed markets outside of the US, emerging market equities. And so this is kind of what a high level, very simplistic, broad-based, diversified portfolio would look like. Now, if we use these weightings that I've applied in this analysis, this is a chart or a slide I want to spend a bit more time on. And some of you may be familiar with it. What you're looking at the top of the slide is called a Callan table. There's an institution out there, it's Callan Research, and they've been doing this for several decades now. And what they do is they look at the performance in any calendar year of every single major asset class. And they then rank that based on how has that asset class performed in a specific calendar year. So how are you going to read this slide? And just bear with me, there's a lot of detail here, but it's important that we unpack this. Is on the left, you will actually see a little bit of a key in terms of what are the various asset classes that they've looked at, and those are color-coded. So if you're looking at, for example, at the top, emerging market equity in the orange color, that's color-coded up here. And then when you read it in this chart, in this heat map, you can see in 2005, top performer, emerging market equity. Second best performer in 2006, then 2007, and then you get to 2008, and it's the worst performer. So that's how you're reading this. If you're looking at real estate, similarly, you can see it bounces all over the show in terms of how it's performed over, let's say, the last 15 years. Now, the key takeaway that I want you to just observe, just looking at the data, this is hard data, right? If you look at this, you can see that often any particular year's best performer could be the next year's worst performer, by and large, if you look at that. So chasing a trend, chasing what's hot, is sometimes not the smartest approach in terms of managing your money. I mean, look at real estate, 2006, 42%, then the worst performing asset in 2007. Now, if we look at that, the other important thing I want you to just look at is a balanced portfolio. That's this pinky color, right? And if you look at the balanced portfolio, that's what ties up to the slide before in terms of this asset allocation we've discussed. Very simplistic, not changing the weightings, just trying to keep that reweighted every year, making sure your weightings are actually equal in terms of your intended strategic asset allocation. And what's remarkable here is the balanced portfolio. Yes, it's never the top performer, and it's also never the bottom performer. If you look at this, you can actually see on the slide, it's never the bottom performer either. And what you're getting from a balanced portfolio is this nice, even middle of the pack, sometimes actually top of the pack, number 3 position in 2004. I must say this surprised me. I wouldn't have expected it to have performed that well in calendar 2024, but it actually was the podium position, number 3. And what this balanced portfolio is aiming to give you is effectively the ability to sleep easy at night, the ability to extract good risk-adjusted returns. And let's actually unpack that a little bit for you, because even in major sell-offs, if you look at the balanced portfolio in 2008, 2022, you can actually see in those years, it significantly outperformed. Yes, it was down. 2008, global financial crisis, terrible time. I remember sitting at my desk, trading desk at the time, everything on the screens are red. And you can see that because barring cash and maybe fixed income, because obviously they cut rates thereafter, and you had bonds performing reasonably strong in the latter part of the year. Other than those asset classes, everything else was solidly in the red. And yet, if you look at your balanced portfolio, you actually preserved over 20% versus if you were just invested in emerging markets, for example. And then similarly, if you look at it over various timeframes, 2022, if you look there, actually outperforming a lot of the other asset classes there. If you look at the best absolute return, 2009, so that's the bounce that we had after the global financial crisis, solid performance. If you look at it on a relative return basis, its best relative return was actually last year. It was ranked just behind US equity. If we split that up into small cap, large cap equity, a balanced portfolio actually performed just behind US equities and at significantly lower risk. So the point I'm trying to make here is that a well-diversified portfolio is the ability to sleep easier at night. It's to give you solid, steady returns over time. And it often ranks in the top 4 out of those top asset classes. It's not meant to be flashy, but it's meant to be dependable across market cycles. And this is why I stress that diversification is important. It's actually your first line of defense. You're going to look bad if you go to the braai on a weekend and you're more diversified than someone who's maybe invested in the top performing mega cap, certainly last year in the US markets. People are going to look at you and say, oh, you're underperforming. But just wait for the cycle to turn and you can see that this is actually your first line of defense. Now, I'm going to pivot from that into a look at what does this mean in terms of a smarter overall portfolio framework. And here I'm going to discuss a couple of key things. I'm not going to spend too much time on this because this is more conceptual. It's to try and get you to understand how you can execute some of this. And we're going to play that through into what does this mean in practice. Now, the first step is actually just acknowledging the need for a well-diversified and global portfolio. A lot of you are sitting in South Africa. I don't have to tell you, South African markets can be outperformers in some years. They can be underperformers in other years. I'm not here to slam any particular geography or any particular market. What I am saying is, as an investor, you should apply a global approach to your portfolio. And when you're doing that, that can be quite daunting given the variety of options that are actually out there. So what generally tends to work, and again, these are some of the learnings that I've seen from the institutional space, is that a lot of the larger investors build a core equity. It's usually equity because that's where you get the growth from over the longer term. They build a core equity holding. And that core holding really needs to form a stable foundation. So it needs to be broad. It needs to be diversified. It needs to be your longer term holdings that you don't necessarily play around with too much. And then around that, that's where they get fancy. So you might want a geographic tilt. Maybe you think China's the next opportunity. It was sold down quite hard. So you might want to take a geographic tilt to China. That's not going to happen in your core portfolio. That's going to happen in these little satellites around your core portfolio. You might want to play a thematic there's a thematic investment that you want to make. Maybe it's ESG, for example. You might want to add that as a satellite. But those tend to be tilts and satellites around a core that is stable and that is actually meant to build a foundation of your portfolio. Now, the important thing here to note is when you are considering your core versus your satellites, you need to consider what is the correlation between the various assets that I'm putting into my portfolio. And again, I've got it on the bottom here. This is just something where if you look at the major asset classes, equity, fixed income, property, cash, and gold, how do they correlate to one another? Do they move together? Again, for those not familiar with correlation, if assets move together, if they move together perfectly, that table will show you a 1. And if assets move together in the same direction, but maybe less perfectly, so if you look at equity versus real estate, for example, at around 60%, they move together. So if they move together, the higher the ratio, the less diversification that asset is giving you versus your core, and it's called equity. And what you can see from this is if you look at cash, you look at gold, obviously those are not going to be correlated assets to equities. Fixed income, still a reasonable diversifier to equity. They do tend to correlate at times. They tend to move together. But overall, over the longer term, this kind of diversification from non-correlated assets is what gives you superior risk-adjusted returns. Now, a last point on the slide, bottom right, you can see that's something called an efficient frontier. Now, I don't know how many people in the retail space will be familiar with this, but in the institutional space, just using usual portfolio theory, this is to show you how if you map various asset classes, and that is a Monte Carlo simulation, it's run on 4 specific asset classes, and it maps what is their individual return versus a level of risk. And that's what you see on the little X's that come through. And then if you combine those, given the non-correlated nature of the assets, if you combine those, you can actually derive similar returns at a much lower level of risk. And that is really the theory behind diversification and behind just blending these non-correlated assets into your portfolio. Again, we can spend some time on Q&A if you have some questions around that. That's just for you to understand the concept behind what we're discussing here. Now, very importantly, and I am cognizant of time, so I'm going to move a little faster, not all indices are equal. And this is so important because, again, you'll see it on the news. You know, today the S&P was up by this and the Dow did this and the NASDAQ did that. But a lot of people don't actually understand these indices because index structure actually affects your returns, it affects your risk, and it affects your diversification. We've discussed some of it on the S&P 500. And if you're looking at that, the S&P 500 is effectively a market cap weighted index. It's effectively 500 stocks in the US, but because it's market cap weighted, we've discussed this, the larger companies have a disproportionate influence. Now, I'm not going to spend time on that, but because we have discussed it already, but it gives you a sector bias at present. It is very tech heavy, tech focused, and that's some of the pitfalls of just looking at the S&P 500 as an index by itself if you were investing in this passively. And what's the Dow Jones? Because a lot of people see it. I'm sure you see it on the news, but a lot of people don't realize this. For me, it's one of the more interesting talking points on the slide. The Dow Jones is only made up of 30 companies. And what's interesting for me is that it's actually a price-weighted index. Now, it's a very old index. This is an outdated weighting methodology. But what it means is that the higher the price, the share price of a specific company in the index, the higher a weighting it gets. Now, again, now that we've moved on and transitioned from that and thinking has evolved, you can see how, I'm not going to say ridiculous, but you can see how that can lead to very unexpected outcomes. So, for example, Goldman Sachs has a high ticker price at over $600 a share. So this means it currently makes up around 10% of the Dow Jones index, which is just remarkable. And that's actually a bigger weighting than Apple, because Apple trades at, let's call it around $200 thereabouts. Apple's weighting in that same index is only 3%. So you can see how the Dow Jones is giving you massive distortions because the rationale behind having a higher weighting just because a share price of a particular company is higher just doesn't resonate well in terms of an overall strategy for me if I were investing in that index as a core holding. And then lastly, the NASDAQ. This tracks the top 100 non-financial stocks in the US. And it tends to be tech heavy, again, similar to the S&P now, just given the massive size we've seen from Microsoft, NVIDIA, and some of the bigger names. And it's highly concentrated. So it's basically two sectors. They say the tech heavy NASDAQ, but it's basically tech and consumer discretionary stocks that are making up 70% of that portfolio. Sorry, I heard something on the line. We all good? Okay. So, the consumer discretionary stocks and tech stocks, 70% of the NASDAQ, that gives you a massive skew in terms of your exposures there. And it's great in bull runs. We've seen that in bull runs. The NASDAQ outperforms, it tends to outperform, but it is fragile in downturns. So the purpose of this slide is just to highlight to you why it's so important to understand, even when looking at headline indices, you think you're so diversified, but the methodology on the index actually plays towards giving you a very skewed exposure across sectors and to specific stock names. Now, let's bring this all back into practice because all of this is useless if we don't show you what does it mean for you today in this discussion with Mesh, with AnBro. And what I've tried to do here is I've tried to say, great, so we've discussed diversification and a core satellite approach. How does this marry to what Mesh has on its platform? Again, by no means a recommendation or financial advice. It's just to show you that it's not just theory, that if you want to execute on some of this in your own portfolio, in your own thinking, that it is possible. And what I've done is, on the left, that's obviously the schematic I showed you from several slides ago. But on the right, I've tried to map this against what assets are currently available in those specific asset classes on the Mesh platform. And as you can see, and we'll get into the reasons as to why I've got Titans, Unicorn, and Brands. Those are AnBro's portfolios as the core. This is not a sales pitch. I'm not with AnBro. I'm certainly agnostic, but you'll understand in some of the thinking when Justine discusses how Titans is diversified across sectors and their methodology around there, why it could be a strong contender for the core equity holding. So let's assume that this all stacks up. You've got Titans or Unicorn or Brands, depending on your particular approach, as your core portfolio. And if you're looking at private assets, you've got this DEMOS, which is a 10-year paper, prime linked. That's a private asset. It's effectively giving you exposure, yes, in a fixed income form, and not necessarily private equity, but that could fall into that particular portion or allocation of your strategic asset allocation. You've got the ability to hold cash. You've got the ability to hold gold. Like I said, we've done that fantastic webinar on the Troy Gold launch with Mesh. So gold certainly an asset I'm quite fond of. You've got Bitcoin and other crypto in there. Then you've got the Satrix bond ETF on the top. If you want fixed income exposure, or if you want global fixed income exposure, you've got the Satrix Global Bond Feeder. And then if you want higher risk stuff, you've got emerging markets, or you've got, for example, I've looked at the platform, you've got the EM from Satrix, India, China. These give you the ability to have that thematic or that geographical tilt around the core. And the reason for the slide, again, like I say, it's not financial advice. It's just to say, if we were to take the theory into practice, what could that look like? And this is pretty much showing you that the tools are all there for you to be able to execute on the kind of thinking that you usually see in the institutional space, to be able to execute on that as an investor in your own right. Let's summarize all of this, because I'd love to bring Justine in. What are the key principles, right? Is that investor bias is common. Most often portfolios are skewed towards equity, or maybe you're sitting heavy in cash because you're risk averse, or you might have a lot of property. And that's not necessarily the best way to view your overarching portfolio. The next point is that your headline indices, if you're just buying a tracker or if you're just investing passively in some of these indices, they tend to be top heavy, either skewed towards specific sectors or specific stocks. And that is risky over time. Then if we look at, and that was discussed in the index structure point, so I'll leave that with you. The other thing was, going back to that heat map I showed you, is performance tends to rotate depending on where we are in an economic cycle, depending on what's happening geopolitically. And so last year's winner, the winner over the last several years, sometimes we had an asset class doing well over 2 or 3 years and then falling all the way to the downside in the next year. That shows you that you're never going to be able to pick a top and a bottom. Sometimes if you're riding the wave, you're just exposing your portfolio to a lot of risk over time, and that a more deliberate approach toward diversification is required. The other point is that balanced portfolios are resilient. It's rarely going to be the best, but it's never the worst. And I think that's an important point. Remember that correlations matter when you're adding different assets into your portfolio. Another point is go global. As a South African investor, you are exposed to currency risk with the rand. Sometimes it does well, sometimes it doesn't do so well. At the moment, it's doing okay, but we had times when it absolutely blows out. So just ensure that you're getting geographic exposure, you're getting FX diversified exposure, you're getting asset class differentiated exposure. That's really important to execute within that overall core satellite approach. And then remember, I hammer this point home, it's about resilience. It's better. It's more than just chasing returns, chasing the best performing asset. It's about what risk am I putting to my overall portfolio over a long period of time to actually derive those returns. And that is what frames good, solid thinking when constructing your portfolio. Now, we're going to jump from that into a discussion on Titans. I'm not going to go through all of this. What I do know, and Justine, I'd like to bring you in here, is that Titans, you've got exposure across 11 sectors, all of them on the S&P 500. You avoid some of the pitfalls of that mega cap distortion. And I want to discuss this with you. You've got a global exposure, so it's not necessarily to say that it's all just US exposed, because if you're concerned around the US, what does that mean? Justine, maybe I can pause here because I think we'll take Q&A as part and parcel of the discussion we're going to have. But I want to unpack some of these key points on Titans. And I think you're definitely a lot better positioned to discuss the technicalities around Titans and why you could make a case for that as a solid core holding in a portfolio.
Yeah, thanks very much, Mo. And from my side, great to be here and to see so many people, obviously, in the industry that I know. And it's lovely to be here with Mesh and all the people on the webinar. Always difficult to follow Mo. He does such a great job of these things. But from my side, just Mo, to start off after such a great sort of breakdown, if I give you an idea, we have now going on to 4 portfolios on the Mesh platform. And before we get into just Titans, to give you some thinking on where all this comes from, if you look at our portfolio in AnBro, our model portfolio across the last 11 years, we started off and we've got Titans, which gives you a blue chip exposure. It gives you, from that perspective, you've got a blue chip exposure. We've got global brands, which is more thematic based and allows you to look beyond just US S&P 500. You've got China, you've got Korea, and you've got a whole lot of other aspects across Europe.
Can you talk now with that?
I can, sorry. It's okay. I'll just talk louder. And going back to it, so you've got a global brands portfolio, which is more about thematic exposure beyond just the US listed S&P 500 portfolios. And then you've got the dynamic compounding portfolio, which is very high dividend compounding opportunity, and then very high beta unicorn, next generation biotech, fintech type portfolios. Now, what's happened is we've broken that whole model portfolio into these 4 individual aspects. For whoever is looking for a high beta or high growth piece has unicorn, and they can have something like either global brands or Titans below that as a core. Why is Titans now coming in? What does it do? What's different? And I think the best way to start is Mo's comment about exposure to all 11 sectors of the S&P 500. Now, if you buy the S&P 500, you are getting exposure to all 11 of those sectors. But what starts to happen is that if you take the normal market cap weighted piece, to Mo's point, where he spoke about sort of the top 10 stocks, which pull it across 30 to 35% of the performance of the index up or down, you are then really, heavily focused on tech. And you can include a little bit into that, which is finance, which is Berkshire Hathaway, maybe Eli Lilly comes into that as well. In our portfolio, what we did is we looked at all 11 sectors. We took the biggest 5 or 6 stocks in those sectors, and then we equally weighted all of them across those sectors. Now, what does that mean when it comes to, market cap distortion, and why did you do that? Well, the first thing I'd like to sort of mention quick from my notes here is, if we look at stocks we know, a stock like Meta, which is out there, we will use Facebook, Instagram, etc., and we think of Meta as a performance, sort of driver and how well it's done. Well, actually, up to May, over the last 3 years, Meta gave us around 220 to 236%, depending on where you call it at the end of May, as a return over 3 years, and it's ranked 6 in size from a market cap weighting in S&P 500. At the same time, under the utility space, Vistra Energy gave us 405%, but it's ranked in the bottom half of the S&P 500, and actually accounts for about 0.06%. Now, we're not to say that every single 3-year period Vistra is going to outperform Meta. However, in this case, you can see how having an equal weighting across all 11 sectors would have brought Vistra into the performance of your portfolio. Another one that's worth looking at is one we all know, Microsoft, usually the top 2 or 3 on the S&P 500. This is a massive company with a $3 trillion market cap. 85% return over the last 3 years. Then you've got Costco, which is arguably as boring as someone like Macro. And I say that with all due respect when compared to a Microsoft. And yet Costco, which is ranked around 17th to 20th, depending on the year over the last 3 years, returned 119%. So even going back to something, which is in consumer retail, you would be squashing those returns down into the real bottom part of your portfolio relative to that top 10, which Mo spoke about, just 30 to 35% of the portfolio. A couple of interesting things about Titans is we spoke about the different sectors. The sectors are known as the GICS sectors, GICS. That is the Global Industry Classification Standard. And the reason for that is it gives you an opportunity to understand what you're investing in and where they are in those sectors. And those sectors include things like financials, industrials, consumer retail, healthcare, etc. Now, we break down in Titans the top 5 or 6 in each one of those sectors. And that gives you an opportunity to get the exposure you need without having to be skewed towards market cap rating. The other thing it does is that it's very difficult to look tomorrow and think, what will outperform? The reality is, if you look at what Mo spoke about in the cycles, we've had COVID, before that, financial crisis. We've got wars going on around the world right now. I flew here and I was actually surprised at how few options you have based on how much the war in the Middle East is actually taking out airspace in the world. And I think when you are able to look at something and take the biggest and best stocks who are highly resilient in each sector, what you start to have is a much more equally weighted approach to your investing as a core. In that, what I would say to you is that we provide the screens on our side. So it's not just, let's go out and find, the biggest 5. They do have to pass several different screens on our side, which is liquidity, their ability to grow, their ability to produce dividends, to grow dividends. And in that comment around liquidity, if liquidity is something you're looking for in a portfolio, this is arguably one of the most liquid portfolios you could ever own. I mean, we've spoken to the PRC, we've spoken to several big asset managers, and when they came to us, it's actually incredible how big this particular portfolio is in terms of liquidity. The smallest stock in this portfolio accounts for about 1/3 of the total JSE turnover in a single day on its size. So that's just to give you an idea of how liquid this portfolio is. So if you're ever worried about buying something you can't sell, well, you can definitely sell this. Hopefully buying more than you can sell, but that's how it is. And then, Mo, if there's anything else you want to start with from sort of digging in deep there or asking a question, please jump in there.
Yeah, so it's very interesting, but I want to get into the nuts and bolts of this because at the end of the day, I think a deep understanding of what exactly one is getting in Titans. I mean, I've just gone wax lyrical about how you got to understand the S&P and the NASDAQ and the Dow. So I want to understand Titans a lot better. And you mentioned the 11 gig sectors. That's great. You mentioned something of methodology around that. The first question for me is, you look at capping exposure to specific stocks, so that's fine. That helps you diversify the portfolio. What does that look like in practice? Are you looking at that weighting on a sector basis? Are you looking at that weighting on a stock specific basis? So what I'm trying to solve for here is, am I going to get an equal weighting to sectors, or am I going to get an equal weighting to specific stocks? What's the methodology behind that?
Effectively, you have 55 to 60 stocks, which are equally weighted. So it's one man, one vote, which is a quote I'm stealing from one of the audience members here today. It's not my quote, it actually belongs to her. But it's equally weighted. So each of the 55 or 60 stocks is equally weighted across the entire portfolio. So by doing that, every single stock carries its own weighting. And when you get to the end, it has an annual rebalancing. So when you get to the end, I was actually asked on the roadshow this week, are you not getting to the end of the year when it comes to the rebalancing and sort of, watering the weeds and cutting the grass when it comes to this portfolio? And the reality is we're not. We're actually looking at a portfolio which over time through the sectors and as sectors perform during times is actually being rebalanced without prejudice. So when it gets to the end of the year, and if we've had a year like 2024 where NVIDIA absolutely shot the lights out, you get to that end of that year and AI was all big talk and we were trying to see where we were going and nobody was sure as how we actually make money out of AI. We're starting to see that starting to come through more now. We've seen oil shortages. We've seen suddenly oil and the cost of energy spike over the different wars. Utilities then perform. What we're trying to do is make sure that we are trying to even out the returns and even in the sort of hedging that, let's call it, more unknown areas of the S&P 500 actually provide you as a defensive strategy.
I like that. And I'm going to maybe pivot from that a little bit because, again, in the institutional space, you've got to take the emotion out of it. So I like the rules-based approach to rebalancing because quite often what I see a lot of investors do wrong is they get caught up in the narrative, right? So like you say, AI is so exciting right now. And they use that as, and I used the example of the investor with a big Apple stake in their portfolio. They got carried along with the tide there because at the time Apple was doing really well. And you need a solid rules-based methodology in terms of that rebalancing. So again, I think kudos to the team for having that embedded as part of the overall Titans philosophy and methodology. Where I want to go with this is I touched on a point, and maybe we can unpack this, is another way to smooth out your exposure to those market and economic cycles is run cost averaging. The ability to invest consistently, smaller amounts, so don't just blow all of the capital in one go and allocate is maybe allocate that capital in a steady method over a period of time. And that helps you get through cycles. Now, where I'm going to go with this is, I know we discussed this off air, but I want you to showcase it because I found it very interesting. Titans is a portfolio that you run for a very long period of time. You just listed it now on Mesh, but it's a portfolio that AnBro has run for a long time. How has Titans performed over the longer term, specifically in crisis time periods? How does your portfolio behave when the market corrects by 25, 30%?
That's a great question because, sitting and going through methodology, what we do, et cetera, and then when the sort of rubber hits the road, what actually happens. So I think I'll use two examples there. The easiest one to use is the recent Trump tantrums that we've had around tariffs. And when that sort of came through in the market in March, this portfolio was down 3%. S&P 500 was down between 11 and 19%, depending on whether you were market cap weighted or equally cap weighted. And the idea behind that was that having an equal weighting amongst the best of the best defended you during that time period. That's the one piece. The other piece is we have actually run this portfolio, and it was one of the original core, as I said to you in the beginning, of the portfolios we ran, and our real sort of US exposure piece in our portfolio. And the reason that we did that was to have exposure over the time. We wanted something to be intelligent. It's quite easy to go out there. There are so many choices, even as an investor. Depending on where you are in the world, you can literally buy anything. So we thought, let's buy the biggest and best in each sector. What did that translate to? Well, after 10 years, our portfolio's average return on an annual basis, so average annual return is 21.9% versus S&P 500, which is around 14.9%. Now, when we started, we didn't anticipate the portfolio would actually end up outperforming consistently like that. And the reason being that we didn't anticipate it was we never realized how big over that time period certain sectors would suddenly become. So you take a 10-year period and you go back and you think of how big tech's become, how fast companies go, like an NVIDIA, and suddenly there are huge swinging companies when it comes to their weighting in terms of performance. And so by having it on a basis where we've been able to continually go back, make sure there's an equal weighting, we've avoided the scenario like you would have in SA with Prosus or Naspers being such a huge weighting in the top 40. So for us, the performance over time has also taught us a lot of lessons, because we've been able to see that consistent return, but also in the near term, when it comes to things like Trump and having unpredictable markets, it's provided a very defensive position in those time periods.
Jess, I've got one more very important question. It's a burning question, and I'm happy to open it up to our floor because I'm sure our participants have questions as well. I see some questions coming through on the online chat as well. What does geographical diversification look like in your portfolio? I mean, this is investing in stocks on the S&P 500, but you and I both know that those are global companies. Those companies that have exposure to Europe or emerging markets. Do you have a geographical breakdown? What does that look like? And I'll tell you why I asked specifically. There's a lot of concern around, US exceptionalism. Can it continue? And in fact, I'm going to blend this in with the question that's on the online chat as well. I'm going to ask it on behalf of the participant who said, with sector balance and equal weighting, do you think Titans could outperform traditional S&P trackers over the next 5 years? Now, for me, if I take that question, I look at it in the construct of what we've discussed as well, is that there are different cycles. There are different market cycles, economic cycles. No one has a crystal ball. I get that. But my question is more around what does the true diversification look like within your portfolio geographically? And do you think that positions you optimally versus, for example, a passive index like the S&P 500? Just marrying those two questions together.
Okay, so I think it's a very long question. So if I don't answer it or if I go left or right, please just bring me back to the middle. Yeah, and I can always bring Craig in as well. He's with us as well. Craig's our CIO from AnBro. But one of the first things I'd kick off with is, yes, these are the biggest and best that we've put into Titans in the States, which are sitting in the, these are S&P 500 companies listed in the US. US has currently the biggest or deepest capital markets. But we're going to leave here today and drive home past McDonald's. You've got Amazon here. You're using Google or Microsoft when you're on your computers around the world. These are global companies used and deriving revenue across the globe. So when you are in, Vietnam and you open up your laptop, you're using Microsoft most likely. You may be using Mac, or maybe there's some of you using Linux or something like that, but you'll be using it. So these are not just US, let's call it, dependent companies. These are global companies that are there. Just remind me on the second part of the question.
So the second part of the question was from one of our attendees who says, with your sector balancing and your equal weighting, do you think that Titans could outperform a traditional S&P tracker over the next 5 years?
So, look, we wouldn't have launched Titans if we didn't believe in the construct of that. But let's be honest, there are always, and we see more of them, world events that come out of nowhere. One of the things I want to explain to you is that Titans inherently is a, let's call it a smart passive strategy, because it's only going to be rebalanced once a year. However, I'd like to bring a real example, which is actually quite a tragic example, into it, which pertains to the healthcare sector, which is United Healthcare's CEO was actually murdered in the States. Following that, a very interesting sort of thing happened that nobody could foresee coming, which was Elon Musk and Doge in the US government suddenly cutting a whole lot of people out of the US government from an employment point of view. Now, those people, believe it or not, all had United Healthcare. So they knew they had about 3 months before they were leaving. Guess what they did? Had their teeth done. They went for checking everything out. They did which had a skewed effect on United Healthcare, which made us relook at that particular stock and really think about its involvement, even though we would only look at an annual rebalance normally. So when there is a really sort of out-of-the-world event that happens, it means we've really got to go and look at what's in there. But in order to really maintain the strategy and the way in which this portfolio builds its performance, we've decided to look at it on annual rebalance. And so I don't know if that answers it. I think there's more resilience in this portfolio because of the size and the sort of history of the companies and management teams and being the biggest and best than the broader portfolio.
I think that answers the question. Again, if not, I think our participant can certainly put that up on the chat. Justin, wrapping up from my side, I think I've discussed portfolio diversification, why it's important. I've discussed multiple asset classes. With Titans, we're discussing a specific asset class being equities, why, for example, Titans might make a compelling contender for the core portfolio. And just in my own thinking, as we're discussing now, I think if I look at Titans, we're getting, tick the box on geographical diversification. That's a nice one. Because of that geographical diversification, you're probably ticking the box on FX diversification to a degree. We're also discussing diversification across various sectors. Because at the end of the day, I like the discipline. I like you described it, I think, as smart passive, right? And the term in the institutional space is smart beta, because at the end of the day, it's rules based, and I certainly like that. So I'm just synthesizing some of this thinking in my head live while we're on this. And the last question I actually have on this, and again, I'm a numbers guy. Maybe you have the numbers on hand. If not, maybe you can share it. But quite often in the institutional space, people look at specific ratios, like your drawdown ratios, or what is your Sharpe ratio? So a Sharpe ratio is what amount of return are you getting for every unit of risk you're taking. A Sortino ratio, for example, is how much upside volatility you have versus downside volatility to a degree, because upside volatility, you're not that concerned about. You're really concerned around downside volatility. If we look at some of those headline metrics, so drawdown, Sharpe, Sortino, how does your Titans portfolio specifically perform versus the S&P 500, for example?
Okay, so I think out of all of those, the most important one is the Sharpe ratio. And looking at the Sharpe ratio of this particular fund, it is 0.9 versus S&P 500 of 0.5, which means it is technically a lower risk portfolio. Over 10 years, its volatility measure is also lower than the S&P 500. And in the room, thinking about it and to the broader space, if you have the biggest and best, most well-managed stocks, you will have a much bigger opportunity for well-constructed succession planning in terms of management as well. So you don't often find someone like Apple, tomorrow you wake up and they are now producing sweets and they've gone into food. I don't say it wouldn't happen, but we'd be given a lot of forewarning that this would happen. And so I think these are stocks where not only is their sort of management team well-structured in that we know who would be next to take over, but they are also in a position where we know their products and we know what they're doing. So the surprise element is not there. And that talks to why their volatility is actually pretty low, because they're very well understood. There's also a lot of research on these stocks. So we sit around and we actually recently started using a lot of AI tools to actually analyze these particular companies because they're so well covered. And because they're so well covered, it's impossible for you to sit and look at every single analyst. So we look sometimes at the delta, what's the difference between the analysts and what they're saying, but they're so well covered, and that talks into that point from my side, mate.
Thanks, Just. I want to open up the floor to our participants. I know we've had the online participants being able to submit their questions. I know that there are people in the room with you, Justin. Happy to take questions either for yourself or for myself on some of the portfolio theory stuff that we discussed earlier.
Yeah, I have a question. So this has been fascinating. So thank you, Mo. And it's a long time since we last spoke. It was probably back, I don't know, can't count that far back. And Justin, thank you. So a different lens, because I'm in a different stage of life to a lot of the youngsters, right? Is to what degree do you consider the investment time horizon of different asset classes? So, for example, I would look at my life and think I need buckets, short-term, medium-term, long-term, because my risk profile changes depending on my need for those buckets as and when. So I don't want to put all my money into a bucket that's going to be one portfolio, balanced or not. And I like the balanced approach because you do get a better performance over time. But the lens of looking at it through the investment time horizon suggests that you'd have a different portfolio for a short term, different for a medium term, and different for a long term, because, as you said, the Sharpe ratio of the risk in a longer term portfolio, you can take much higher risk and get better returns. So to what extent do you integrate that into your thinking?
I think it's a great question. I think there are multiple ways of looking at this. So one is that you could look at it in terms of saying we create investment buckets. One is long-term, one's shorter term, one's more medium-term. The other is effectively that you would manage your asset allocation based on life cycle. And it depends, again, on who the investor is. So some investors like to do it the one way, some investors like to do it the other way. What you traditionally see is if you manage it on a life cycle, let's break it down to both. If you manage it on a life cycle, early in your career, you'll know a lot of people tend to overweight their equity holdings because they can take more risk, they're earning more money. Then as you kind of get towards more middle life, they downweight that, they upweight the fixed income. Those traditional measures still hold. It's just a question of how you execute on that. And again, if I'm speaking to the institutional space, for example, if I'm talking to an asset manager, that asset manager will go and create specific buckets. So they'll say, if you are early life cycle, mid life cycle, late life cycle, these are our high equity offering, middle offering, lower offering. Effectively to match it to your life cycle, thereby giving investors a product they can buy. A lot of asset managers do that. However, more dynamic investors tend to actually manage that risk themselves within their constructs. So they'll say, in this year, this is where I am in my life cycle. This is what I'm comfortable with in terms of my equity weighting, my property weighting, my alternatives weighting. And then similar to what Justin's doing with Titans, you have a rules-based, anniversary on which you look at that and you say, great, this is now the anniversary. Am I transitioning? Am I still in this bucket? Or am I actually transitioning to a later bucket, and do I need to adjust my asset allocation accordingly? That's just, again, two differential ways of doing it. Justin, I don't know if you have something to add from an AnBro perspective on that. Have you seen something different, perhaps?
What I would add is one of the reasons we fundamentally started our business, so we're going on to our 11th year now, was we saw a lot of South Africans, as South Africans, I'm a South African myself, we are really proxy to a lot of imported inflation. So that whether you're a youngster and you're trying to buy a house, a car, even putting petrol in your car or electric these days maybe, you are in a position where you're importing a lot of things, whether it's your clothing or whether it's what you eat. Even sadly today in South Africa, a lot of your expenses are coming through in hard currency. As we go through our lives and we get older, we're starting to look at medical aid costs. We're starting to look at, when we look at our later life stages, it's looking after parents, looking after children. And the costs of those things, be they education or whatever, there are a lot of components that exist in an imported inflation basis. Now, to answer your question, that's, Bruce, why we broke up our portfolio. So we broke it into high beta, growth phase of unicorn, dynamic compounding, which is more your lower risk but higher dividend compounding components. And then you've got that building block. And I think the best way to do it would be to sit down with your financial advisor or look at how you do it as your investor, like Mo said, on an annual basis, and re-look at those buckets and how they suit you. In other words, how much risk can I take now based on the circumstance I find myself in that particular year or the year going forward? But the building blocks are there, for that process.
But that's great, because then you can build your own bucket portfolio. So you have three portfolios that basically include investor time horizon, and the risk return profile of a Sharpe ratio.
Absolutely.
Cool. Thank you.
Just, I love that insight. Sorry, I love that insight because, again, you've discussed Titans a lot. I'm familiar with your dynamic compound. It's lower risk. So again, what you've just said is testament to the fact that as an asset manager, you've created different buckets that tie into different risk appetites. Because sometimes Bruce, to your point, sometimes it's related to where you are in your life cycle. Other times it might be related to other instances in life where maybe people have had a hard knock on income and now they're just not able to afford to take a lot more risk. So it might not be age related. It's very much life cycle related. And again, Justine, thanks for sharing that. And Bruce, great question. Thanks so much. Any other question? Louisa, I hope I'm not overstaying my welcome here. I know
not at all, no. You can never overstay your welcome, Murray. You're always a joy. So thank you so much for that wonderful presentation. And Justin, thank you very much for giving us a more in-depth insight into Titans. I just want to wrap up today to thank very much the wonderful people who attended this webinar. We really appreciate you coming through the cold and spending this time with us. And thank you everybody online for your participation and for the time that you've spent. Thanks very much, everyone, and have a fantastic weekend.
Thank you so much.